Alright, so in this video we want to go through a concept that will help you in terms of evaluating a company. Next week we're going to get into some of the specific ratios, but today I want to give you a way of evaluating that kind of sets the tone that will help you to better use your ratios that we're going to talk about next week. And basically the concept I want to go over today is market share, right? And there's a graph that I'm going to draw, and kind of a quadrant thing that we're going to look at that kind of explains the relationship between market share and the industry, and helps to kind of plot, if you will, or categorize a particular business in one of these four quadrants, right? So you've seen these quadrant charts before, right? So you've got an x-axis and a y-axis, right? And so depending on where you plot the company, it's going to fall into one of these four categories that we're going to talk about today. And so really, market share, just to kind of define it so it's in your head, is the percentage of, you can either do it by sales or by some other factor. Typically it's either number of sales or dollar volume, depending on how you do it. But the idea is that, say, we'll just throw out a number, if there's $1 billion worth of your product sold globally, or we could even do nationally if we wanted. So we'll just stick with America for today. So $1 billion worth of, not necessarily yours, right, but whatever product you're in. So if you're in tennis shoes, right, which obviously it's a lot more than $1 billion worth of tennis shoes sold each year, but just for argument's sake, say if there's $1 billion worth of tennis shoes sold each year, right, and if your company sold 10 million, right, then you would divide 1 billion by 10 million, probably what was that, 1%? And so you would have a 1% market share because your sales from your company, right? So you sold 10 million worth of shoes, right? Which is still a lot of shoes, right? So you've got 10 million of the total number of shoes was 1 billion. And so your 10 million in sales would represent 1% of the total shoe sales that go on in the country. That's your market share, right? And so you would have 10 million, obviously 1 billion divided by 10 million gives you the 1%. So that's how you determine market share. So I did that in terms of dollars worth of sales. The other way you could do it is if you said there are, say we'll use the 1 billion again, 1 billion pairs of shoes. Right, so 1 billion pairs of shoes, and you sold 10 million pairs of shoes. Right, so you see the example. So you would, in that, it's still a 1% percentage with these particular numbers that I chose. The variable that I changed is, in one scenario, you're talking about how many dollar sales there was, right? So we had 1 billion in sales, $1 billion worth of cash that changed hands over shoes. And in the other example, we're talking about the number of items sold, right? So that's the two ways that you could evaluate market share. You either do it as a percentage of total sales, or you do it as a percentage of total items sold. However you do that is kind of up to you, but they both will give you a market share number. Probably, the different ones could mean different things. Let me give you an example for cars. If I owned a Ferrari dealership and I sold 100 Ferraris, if you did it with just simply the number of cars sold, my 100 Ferraris that I sell wouldn't seem like much compared to all of these other cars that are being sold. But if my Ferraris cost $500,000 to $1 million each, my total market share in terms of dollars is going to look a lot better than if you just did it by total number of cars sold, because the Ferraris are worth a lot more. They cost a lot more per unit than just a, say a minivan or something, right? Or a Prius or something, So the idea is that whenever you're doing it by total cost here, that kind of gives you a bottom line of your market share in terms of dollars that you don't necessarily capture sometimes in just the product, because the products could be different prices, different quality, but still within the same industry. So the Ferraris and the Prius are still in the same automotive industry, right? Now you could further segment that if you wanted, and you could have, say, economy cars versus super luxury cars, and then they would no longer be in the same category. But if you just went with that category, just as an example, so that we can understand this, I sold only 100 compared to, say, 5 million Priuses, but my 100, which would give me a small, very small market share, and if we did it this way, with just number of items sold, I'd have a very small market share. But if you did it in terms of cash that traded hands, my 100 Ferraris might be comparable, with the large number of Priuses or whatever, or it'd be much more comparable, right? So it's a different percentage there, right? And it works backwards that same way. Just because somebody has a high dollar market share percentage doesn't necessarily mean that they're selling the same number of items, right? So if you look at it this way and you say, oh, wow, you and your competitor, maybe you have a competitor that also sold $10 million worth of shoes, right? One difference here is, say your shoes cost $10 a pair, right? They're economy. This person's shoes cost $100 a pair. So in order for you to have hit 10 million, you had a whole lot more shoes that had to be sold, right? So it's possible that your costs were a lot higher, because a lot of times the $100 pair of shoes don't cost $100 to make. They don't cost 10 times in materials what the cheaper shoe does, right? Because a lot of times it's comparable materials, rubber, leather, so there's probably a greater cost, but often there's a higher margin of profit, higher profit margin on the more expensive items, and so they're selling less of them, right? And so you got to figure out where your company is. But anyway, so those are just some thoughts about market share, so that we understand when we're talking about this example what market share is, right? That market share is your percentage of the market, right? And it can be understood either in terms of dollars or in terms of units sold, right? Okay. And you get different numbers with both, right? So someone that has a high market share in terms of units sold does not necessarily have a high market share in dollars, right? Because there's different values associated with different people's products in terms of what they're selling them for. All right, so this quadrant that we want to talk about today, we're talking about evaluating a company and having a framework in your mind for how to do that. And so next week we're going to look at the ratios a little more specifically. We want to talk about earnings to assets and some things like that. But today I want to talk about a market share framework for understanding it. So this is often used in marketing, right, to understand where your company is, but it's also useful for evaluation and like what we're doing in this course. So along this axis here, right, we're going to put the growth of the industry. Okay, growth of the industry. And then down here, we're going to put profitability slash cash flow, right? The amount of profit that you're coming in from your business versus the growth of the industry, right? And so if you're high on this axis, right, towards the top of this axis, that means you are in an industry that has high growth, right? So an industry that might have high growth right now might be nursing homes, right? I know that sounds weird, but the baby boom generation is retiring, and so the age of the American population is going higher because people are living longer, right? So that puts more people into what we would classify as retired, 65 and over, because many people are living, 7, 10, 15 years longer than they were just, 40, 50 years ago. And so that extends out the number of people that we would classify as retired, which is eventually going to probably push the retirement age closer to 70 at some point, just by virtue of the fact that people are living longer. And so a particular industry that might be booming is anything that's associated with old age, right? Because the baby boomers are getting older. We have a significantly larger, older population than we've ever had before. And so products that are geared towards the elderly or things they might be interested in, nursing homes, vacation homes, health care, any of those types of things that they might be interested in would be considered perhaps a high growth industry right now, right? A low growth industry would be VHS tape sales, right? Something like that. Nobody's wanting VHS tapes anymore. So while there was a time that VHS tapes were a booming industry, they are no longer. So this is on a sliding scale depending on the current situation. That what is a high growth industry today does not necessarily mean that it will be one tomorrow. So your evaluation of this company is on a sliding scale. So one of the first things we want to know is, what does the industry look like, right? You could be a very well-run, very disciplined, very organized, very creative company, but if you're in the wrong industry, your potential is capped, right? So you could have the best marketing, you could have the best infrastructure, you could have some of the best people in the world, but if your product is VHS tapes, your sales are going to be limited because you are in an industry that is dying and that nobody really wants those products anymore, right? So the evaluation of the company is not just looking at the company in isolation. It's not just understanding how well they manufacture things. It's not understanding how efficient they are. It's not just understanding what kind of leadership they have. It has to be understood in the framework of the industry that they are involved in, right? So this first variable here on this side, the vertical up and down variable, is the growth of the industry. Is it a high growth industry or a low growth industry? And this variable across the bottom is profitability, cash flow. How much cash is this business producing, right? Because ultimately, that is the sign of value, is that they're able to produce returns, right? You could have a lot of assets, but if you're not producing returns, you will burn through those assets, right? You could have $10 million in your bank, but if you have no more money coming through, and your bills are still the same, right? As a company, you've got, whatever bills you have. If your income all of a sudden is low or negative, it won't be long before you will burn through that $10 million. And so the asset itself, an evaluation of assets, if somebody came in, they said, wow, look at that, they've got 10 million, very healthy company. Maybe not. If the cash flow has dried up, then it will eat into the assets. So the evaluation of the company cannot just be an evaluation of their assets. It also has to take in mind profitability, right? And profitability is a factor of a few things. You could be in a very good industry, but maybe you're not making much money, right? And so it's not the industry, it's something with your own company. And so what we're going to look at with this quadrant is, what does charting and plotting your business, according to this chart, what does it mean for each of these 4 categories if your business was to find itself there? So we're looking across the bottom, how much cash flow, right? Is your company producing over here on the high end? Are you producing a lot of cash? Or are you back over here on the low end and not producing hardly any cash at all, right? So this quadrant here is high growth, right? The industry is high growth, and it is high profit. The company is producing a lot of profit, okay? Because you could be in a high growth industry and still not be producing profit. I mean, movies. A lot of times movies and things, there's a lot of potential in that industry. It's not tapped out. I wouldn't necessarily put it as a high growth industry, but it's definitely not a low growth industry either. It's movies are somewhere in the middle. So, and I would put it probably more in this top category that, things like the Marvel adventure movies. I mean, that's a big industry that's booming now because of some kind of neat advancements where they've integrated the television series with the movies, and it's not just one movie, but it's 4 or 5 different heroes that have their own individual movies, and then every once in a while they do an Avengers movie where they're all together, and then in between the movies is a television series that has many of the same actors, and it unfolds the plot even more in preparation of the next movie. So it's really neat things that they're doing with that I wouldn't be surprised if some other film producers try to mimic the integration that they have achieved with this Marvel series. So it's entirely possible that movies is a growing industry, even though it's been around for a while. 3D and some really neat things that are coming out have kind of injected some life into the movie industry. And so we could classify that as at least in this upper quadrant, even if it's not an extreme high growth industry. But just because you're in movies, right, doesn't mean that you are profitable, right? There's a lot of movies that come out that, make just a couple $1 million in the box office and just barely cover costs. Or you could even go, there's some people, they're in the movie industry, but they're doing indie films, that kind of thing, and they're just starting out. They're just doing kind of, they're not in the box office per se, but they're trying to break into the industry, and so they're in movies, but they're not profitable yet, right? And so just because you're in a good industry doesn't mean that you're profitable, right? So you got to take both factors into consideration. The strength of the industry you're in and the strength of your individual company within that industry. Okay, so this category here is high growth and high profit. This one down here is low growth industry, right? But still has high profit. Up here in this category is a high growth industry with low profit. And over here is a low growth industry with low profit. Okay. So let's start off with this one, because this is the one that's the easiest to see. Low growth, the industry's dying, and they're not making any money. So this is a poorly run VHS company, right? Not only is the industry dying, but the company itself is poorly run. And so if a company finds themselves here, it's probably better to try and wash your hands of that and maybe emerge as a different company, do some things, restructure, do something to get yourself out of this quadrant, right? And then over here in this one, this is what you would consider high growth. It's a great industry and the company's profitable. These are your shooting stars. These are companies like Apple. Technology is a high growth industry. Cell phones, particularly when the iPhone came out, was a high growth industry, and they were extremely profitable during that time, right? And so this is an example of the superstar companies, right? They're in the best industries and they're the best companies and the best run companies in the best industries, right? And so those are the two easy ones to see. Hopefully you will not find yourself here, right? And if you find yourself here, then you don't need the class. You're doing some things pretty good already. Although if you are in one of these and you're in my class, let me know. I want to talk to you later. Just kidding. All right. And so the other two categories, I think, in terms of real life application for the small business owner or for somebody that's trying to break into an industry, I think a discussion of these two will be the most profitable for you to understand what this means for your company. Now, if you're just evaluating a company, right, which is kind of the theme of this class, if they're here, you don't want to invest there, right? Here, you would think this would be a great investment, and often it is, but what you have to be careful about here is what comes up comes down sometimes, right? That often these are bubbles, right? That there were high growth, real estate was a high growth industry, right? And there were some really profitable companies that were making loans in real estate and their business was booming. And so they found themselves here, but it was unstable territory. And it made a lot of people a lot of money really quickly, but then it also caught a lot of people on the downturn, right? And a lot of people lost significant amounts, right? So if you're investing in one of these companies, you might want to be careful on this extreme as well. Your analysis here is going to say how much higher can they go? They're in the highest growth industry, and they're the best company there. Is there more to go, or are they at their peak, right? Because if they're at their peak, it's great for them, but it's not a place you want to be investing, right, if they're at their peak, because when something's at its peak, the only other way to go is down. If there's still more room to go up, then they're not at their peak, right? And so that's where your analysis would fall here, and where you might want to have a little caution and make sure you're getting in at a good time. And so, but by and large, these can be good industries as long as you can reasonably say there should be more to come, right? And you begin to watch, because what you're looking for here is there any room left? And if there is, then these are great places to invest. And then what you would do from this is you've identified a great place to invest, and so what you would want to do, remember we showed you the chart last week and how sometimes the price is high and sometimes it's low, but the company itself is still here. I mean, it's still a great company, even if for that week or that month the stock price might have dipped down some. And so what you would be doing as an investor is you say, man, this is a great company. If I can get it at the right price, it's something that I want. Trouble is, on these superstars, a lot of times everybody is watching them, and so the potential for catching them on a downturn is lower, but not non-existent, right? There is still that possibility, because so much of the market is investor sentiment, the way people think, their emotions in the moment. And so what you would be doing is you could say this is a company that has got a lot of potential, right? It's already shown some. It's doing good. It's in an industry that seems productive. And so then what you would do, and we'll talk about this in some other lessons, is look at the timing, right, to find a place where the stock price has dipped enough to where there is room for you to get in and ride the next wave up. All right, but for now, we're just kind of focusing on understanding the situation of a company so that you can better evaluate it, right? And so if you just looked at their financial paperwork, it doesn't give you this part, right? If you just look at how much cash they brought in, if you just looked at what were their sales, it doesn't necessarily give you this part of how profitability is in relation to the industry that they're in, right? So you want to have that part first and make sure that you're in a company that is in the right industry, right? And let's go to this one. Low profitability, but in a high growth industry. Here, the question is, why? Why are they in a great industry and not making any money? And this is where your qualitative things, your ability to look at the company, will help you to determine. If they are low profitability, maybe they just started and they had to put a lot of money into research and development. If that's the case, then this could be a superstar in the making, because it sunk a lot of money in the beginning into research and equipment, but it's in such a great industry, maybe it's going to have some breakthrough that's going to cause it to then become profitable, which moves it from here to here. And those are the real superstars of growth, is when you can catch somebody here that's in a great industry, but they haven't turned the corner on profitability yet, so their price is going to be very low. And if you can get them for the right reason, because maybe they're not profitable yet because they put a lot of money into things that are going to help them grow down the road. Now, if they're low profitability because they're not managed well, because they have an inferior system, like you go onto some people's websites. Like if you go to Amazon's websites, it is streamlined, it's easy, it's quick. There's a reason that they are able to have so many sales. You go into other small mom and pop stores, and you got to go through 5 or 6 things, and you got to try and find it, and it's hard, and it doesn't save any of your information, and whatever it is, it's harder. And so maybe they're not as profitable because their system isn't as good, right? And so there's different reasons. And so that mom and pop store maybe is not a good investment because they're not positioned to grow in the future, because the reason that they're not profitable is because they don't have a good system in place, right? And maybe they don't have the right resources. The mom and pop, maybe they've only got $20,000 in the bank, whereas Amazon has billions. Mom and pop store doesn't have the resources to explode in growth, which is why reading the financial statements is important. If this company has good assets, right, and they've been putting their assets into research and development, and now they're going to be coming along with some things that are going to be profitable in a great industry, then they're potentially a great investment, right? And so ultimately what you want to be is, high growth and high profit, right? So even being in the high growth and low profit can be good, but if you don't stay there, right? So if you have a company here, it is a potential investment, but you got to look at why. You got to be able to answer the question of why are they in such a great industry and are not profitable, right? Now, this last quadrant here is a low growth industry, right? So the industry itself is not changing much, but they're highly profitable. So what would be an example of that? I think a great example of that is, let's say, your local water company, right? It's not growing much. I mean, it's one company, it's water, nothing's booming, nothing's exciting. You don't have too many breakthroughs in that industry. It is what it is. It's there. It's the water company. They provide everybody in town with water. It's not booming much, but yet they're very profitable, right? They make a lot of money. And part of that, one thing we'll talk about later, are barriers to entry. You can't just show up and be the water company in town if there's already is one, right? And so there are barriers to entry. Not every mom and pop who wants to sell water in town can do it. There are significant barriers to entry, and there's typically only one provider for every municipality, right? And so there are barriers to entry. And so in a company like this, where the industry itself is not really booming, but yet they're highly profitable, often for an investor, this is a great thing, because you're not worried about the crash from the high growth industry where everything's booming, which could potentially, get a correction there, like the real estate market. So the industry itself is not necessarily booming. It's stable. You don't want it to be a dying industry, right? If all of a sudden people didn't have to have water anymore, then that wouldn't be a good industry, like the VHS tapes, right? But with water, they're going to need that, right? They're going to need it. And so that's the type of thing where it's not going to go away. It may be low growth, but it's stable. And so this is the question: is the industry stable? It may be low growth, but is it stable? VHS tapes are not stable. That is dying, and it's fading away, and it's not coming back, right? So that's the example of a low growth industry that's eventually going to be low growth and low profit, because you're here, right? low growth and high profit, if this is stable, you can stay here. But if it's VHS tapes, all of a sudden you're in low growth. You may have still made some good profit for those last few years that VHS tapes were being sold at a profitable rate, but because your industry is dying, you're going to move back here. You can't sustain high profit in a dying industry. So the question you want to ask here is the low growth industry a stable one? And if it is, then this is a really good place to invest because they're high profit and low growth. Low growth means they typically don't have to put a whole bunch of money into marketing, and they don't have to put a whole bunch of money into trying to keep up with a growing industry. I mean, you know, your local water company, they're not going around door to door trying to sell water. They've already got that. You know, they've got that. You know, they don't need to invest money in that. They've already got your sales. They've already got the market on that. And so sometimes these low growth companies with high profit are great investment places because they're consistently producing a return, right? And so this is just a good way for you to approach your evaluation first before you start looking at the financials, because the financials tell a big part of the story, but they don't tell all of it, right? And so you want to know first the broad snapshot of the industry, right, compared with what they are doing as a company, right? And so next week we're going to look at a little more into the individual company side of it. But as we do that, understand that if you were going to invest your money, you wouldn't do it by just looking at the snapshot of their company without having an appreciation for what that means compared to the industry that they're in, right? Okay. So next week we'll look at the three different types of ratios and how you can use those three to get a good picture of the health of a company. And so we'll talk about not only some of the top ratios you want to look at, but we'll go through and think through what they're trying to tell you about the company.